may not be exactly the same as it is now. Okay. All right. When it does come back. All right. Let me see where the heck I need this to go away. There we go. All right. So today we'll talk about kind of we've talked a little bit about what the financial markets are already. We'll talk about who the key players are, though. We'll talk about some of the laws that govern it. And we'll talk about the major types of securities that are traded in these securities markets. And then next time, so we'll do that today. Next time, we'll talk about primary versus secondary markets. We'll talk about some investment strategies. We're not going to make you all millionaires, but we'll at least introduce you to the topic. I encourage you guys, by the way, as we're going through this, in case we forget, to think about maybe choosing finance as a major. I mean, if you kind of like numbers and you're kind of fascinated by how the economy works and how that affects money and making money, and consider finance. It's you can make a really, really nice living. And in fact, if you have an advanced degree and a couple of certifications, I mean, you can make quite a bit of money. Heck, if you become an investment banker, you can make millions of dollars. So I don't know. I'm just saying, consider it as a major. All right, then we'll finish up next time with how to read stock quotes. Like when you see those tickers going across, what the heck does that mean? When they say, you know, last trade or this, that, and the other about a particular stock, we're going to talk about what that stuff means. Okay. All right. So essentially, the whole financial markets is about getting money from people that are saving their money to the people who need to borrow money, right? So if you are investing in the financial markets, you are a saver. You are a saver, right? You're putting your money to work. You're saving it and you're putting it to work, hoping to get interest on your savings. Borrowers, the people that are selling companies are selling shares, and in a sense, they are borrowing money from you and me. All right. All right. So it helps companies get the money they need to grow their business, to meet payroll, invest in new facilities, develop new product lines, compete, just whatever they need to do to compete in global markets. Okay. All right. Let's talk about some of the institutions that are the players in these markets. Okay, so obviously depository institutions, right? They are considered financial, players in the financial markets, right? So they get money when you and I deposit our money into them, and then they loan it out. That's how they make their money. They loan it out after we deposit our paychecks in their institutions, right? So there's different kinds. Commercial banks is like, I think we're all familiar with. Bank of America, that's a huge commercial bank, right? And then you got credit unions, Teachers Federal Credit Union, or what have you. And then savings and loans, like USAA is a savings bank. Now, most people out and about that you meet will not know the difference between these different types of institutions, because in recent decades, the lines have really been blurred between what these institutions do. For example, savings and loans, they used to just exclusively make money by loaning out money for mortgages. They made home loans. It's like that was their one loan instrument. So people would deposit their money in them, but most of the loans that they gave out were for mortgages. But anymore, the lines are kind of blurred between what these three types of institutions do. All right, then we also have institutions made up of non-depository institutions. That means people don't have checking and savings accounts. with these institutions, okay? So like institutional investors, make sure you're writing some of these down, would be things like a mutual fund, right? They are an institutional investor. They get money by selling shares to investors. They pool a large amount of money from you and me and you and you and you and you and you, all right? You buy into this giant pool of investment money that they have professional investors who invest it in different things, right? Stocks, bonds, what have you, all over the place, by people who really follow the markets and hopefully know what they're doing. So we can buy shares of that investment, and when the whole pool makes money, you make money. We'll talk a little bit more about that in a second. Insurance companies are also considered an institutional investor. They get their money, of course, by collecting premiums from their policy holders. And then hopefully they, for their sake, from their point of view, you know, they make their money with the premiums, and hopefully they charge enough premiums to still be able to pay out for whatever kind of insurance they sell, right? If you have homeowners insurance and you have a big problem at your house, hopefully whatever they have to pay out isn't as high as the premiums you've been paying over time. And it's not on an individual basis, understand, it's on the basis of all of their policy holders. They have people who work for them called actuarials, or actuarialists, and they set premiums by doing a lot of really crazy statistical analysis. By the way, if you took stats and you really liked it, hey, consider getting a degree in statistics, because they make very good money as well. Pension funds are another one. So they get their money by getting money from collecting money from a large amount of people and then investing it, right? And they make money off of the investments, and then they pay out. They use that money to pay people their retirement. Securities brokers is another one, like stock brokers and bond brokers. So securities brokers, have you ever watched the news and you see the floor of like the New York Stock Exchange, and there's all those people down there with different colored smocks, and they're walking around with like handfuls of tickets between their fingers, and they're screaming and yelling at each other. Like a group of people will go over to one person standing on a little podium, yelling out, you know, numbers, and the people around them are like yelling back at them, and they're writing stuff down. They're actually setting the markets. So you and I can't directly buy stock, for example, on the New York Stock Exchange. We have brokers down on the floor who do that, right? Security dealers, the same thing. So they make their money by the spread, just like you and I hopefully do. So they do it for a living. When I say the spread, we're talking about, obviously, when you buy stock, you want to buy it at one level and eventually sell it at a higher level. That spread is called your capital gain, right? You hopefully get a capital gain, but not always, right? Sometimes you buy stock at this level and, oh crap, it just keeps going down. I'm going to just sell it and get out of it before it completely bottoms out, right? That would be a capital loss, okay? And by the way, we do have taxes on capital gains. We'll talk about that a little bit later. And then there are investment banks. So investment banks organize initial public offerings. An initial public offering is when a company first goes public. Goes public means the first time they sell shares of stock in their company. So they become a corporation. Remember we talked back in, what chapter was that? I can't think of it now. the chapter where we talked about the different types of business entities. And we talked about the fact that doing that initial public offering is very expensive, and it takes a lot of very specialized skills and knowledge to do that. So investment banks specialize in doing that. Investment banks understand they're usually not a standalone bank. They are usually owned by a large bank holding company that also owns commercial banks. So they're a division of a large bank holding company usually. Okay. What else? All right, let's talk about a little bit of the law. I am the law. Oh, if you don't know what movie that's from, you are wrong. It's from Judge Dredd. Okay. Yes, I'm a nerd. All right. So during most of the 20th century, the federal government responded to big financial upheavals by creating laws. That's how we got a lot of these laws. For example, the Banking Act, Federal Reserve Act first. So the Federal Reserve Bank established the Fed. Remember, we talked a little bit about the Fed before. The Fed, or the Federal Reserve System, is essentially a bank for banks, and it is the bank that the US government uses. It also, so as the bank for the US government and for other banks, it extends loans to those banks, is a big part of what they do. They also, remember, they grow, they can, remember those three tools that they can use to either grow or shrink the money supply, to either stimulate the economy or slow it down a little bit, right? That is the Federal Reserve System. That happened in 1913. The Banking Act of 1933, also known as the Glass-Steagall Act, like an eagle with an S-T at the beginning, Steagall Act. By the way, if you ever wondered why certain laws or acts have people's names after, those are the U.S. representatives who wrote the bill, right? You know, U.S. laws, bills or acts are initiate in the House of Representatives, and then they are voted on. If they get enough votes, it then goes to the Senate, and then the Senate votes on it. If the Senate votes yes on it, then it goes to the president, who signs it into law. That's how our laws work. All right. So you often hear the name of the law and then the people who wrote it. So make sure you have Glass-Steagall after this act, because I think that is in one of the test questions. Instead of Banking Act, it says the Glass-Steagall. So it established the FDIC. That was huge, because prior to this, often we'd have a run on a bank, a run. So think about toilet paper right now, right? What happened? For some reason, when this whole shelter in place thing happened, people immediately thought, how am I going to wipe my butt? They started buying toilet paper like crazy. And then as soon as it got in short supply, everybody else was like, holy crap, I got to go get toilet paper too. So everybody just made a run on toilet paper. Everybody was trying to get it. And now it's, you know, really, really hard to get. Well, prior to the establishment of FDIC insurance, Federal Deposit Insurance Corporation insurance on deposit, bank deposits, this happened at banks sometimes. If the economy looked really shaky, like we were headed towards a depression. So in what happened in 1929, right? The big stock market crash, Bloody Monday. People were like, investors were literally jumping off buildings. I mean, people were losing everything. So as a result of that, the U.S. government said, you know what, we've got to do something to prevent people from freaking out, panicking, and wanting trying to take all their money out of banks all at once. Because remember, we talked about the fact that banks make their money by loaning out the money. So they only keep about 10% of the deposits, right, from you and me. They loan out 90% of it. So what happens if all of us freak out and want our money? Well, the bank would go under because they don't keep that much money. So federal deposit insurance is the government saying, hey, bank, don't worry. If everybody wants their money, we will cover their deposits and get them paid so you don't go under. Because if all the banks go under, that would drag the whole economy down with it. It would be disastrous because businesses and individuals could not get the money they need to do the things they need to do. So FDIC was huge. It also prohibited banks, and this changed, but it prohibited banks from selling insurance or acting as an intermediary that would help with IPOs. It was just considered too risky at the time. So that's why they passed some of these laws. There were also some other big laws that came out of the Great Depression, such as the Securities Act of 33. It dealt mostly with the process of issuing new securities. It prohibited misrepresentation of and other forms of fraud that has to do with newly issued stocks and bonds. Here's why that's important. Believe it or not, at the time, if you are a business, doing an IPO, you're a corporation doing an initial public offering, you're selling shares of stock in your company, there was no laws about saying crazy things about how wonderful your business was. You could say anything you wanted. You could say, yeah, buy our stocks at a ridiculous high price because we just invented a cure for the common cold and space travel and time travel. I mean, you could say anything you wanted. It was no holds barred. So the government stepped in and said, whoa, okay, you got to tell the truth. It's got to be factual. You can't overinflate your worth by doing crap like that. So that, I think we can all agree that was a good thing. All right. So we won't spend a whole lot of time on the rest of these, but I want to make sure that you, by the way, obviously you would want to print out this slide and this slide for sure, be able to answer probably all the test questions with your notes and these slides, probably be able to answer all the test questions on the laws. So the Securities Act of 34, it regulated the trading of previously issued securities. So in other words, securities on the stock market, right? The securities exchanges that you and me trade with each other, right? It regulated those trading. It also created the SEC. That was I think the biggest part of the Securities Act of 34. It created the Securities Exchange Commission. They were given very broad powers to oversee the securities industry. They, for example, prosecute insider trading. They are the ones who sent Martha Stewart to prison for insider trading. She got I'm aware that she did or she didn't. She still shows she didn't, but her daughter was dating the CEO of some giant company and I forgot what it was that was happening soon that was going to tank their stock. And so, just so happened the day before it happened, Martha Stewart sold $1 gazillion worth of that stock the day before whatever happened and the stock went down. So right away, that sent off alarm bells at the SEC, and they're like, hey, whoa. Who are all these people who sold owned a lot of their stock and sold it right before it crashed? That is suspect, right? And then when they find out that Martha Stewart's daughter is dating the CEO of the company, who definitely has insider trading. You know, that's only two dots. Not too hard to connect. So that's why she went to prison. What else? So in the 80s, let's understand again, a lot of laws are passed after bad stuff happens. But there's also an ebb and flow to regulations, the regulatory environment. So something bad happens, we pass all these laws, and then nothing happens for a while. And then people start saying, businesses and individuals start saying, hey, this law is too restrictive. We need to loosen this regulation a little bit. But then at some point, it's loosened to the point where bad stuff happens again. And so they tighten the laws up again. And it's this ebb and flow of, you know, regulations. So during the 80s and the 90s, the early 80s especially, the economy was sucking eggs. I mean, like right after Jimmy Carter's presidency, the economy was absolutely in the toilet. And then Ronald Reagan was elected, and he's like, well, okay, we got to get this economy. He was like the Donald Trump of the 80s. He loosened up a lot of regulations and really tried to empower business. While doing so, the economy took off like a rocket ship. So sounds wonderful, right? And a lot of it was wonderful. But remember, we do have to have some regulation. And if the regulations are, finding the balancing point is difficult. It's a lot, it's part science and part art. So in the 80s and 90s, man, you know, the economies really started taking off. Things were rock and rolling. But as we know, what happened in the early 2000s, some of that lax regulation started to bite us in the butt. All right, so in 1999, this is also a pretty big one. The Financial Services Modernization Act of 1999, also called Graham-Bliley-Leach. The Graham-Bliley Act. So it reversed the Glass-Steagall Act's prohibition of banks selling insurance or acting as an investment bank. That was pretty big. It worked for a while and opened up, so we did that for a while. One of the big things that was cool about this act too, though, is it opened up the possibility of ATMs. Did you know that before 1999, every time you freaking needed money, you had to go, well, you physically walked to a bank branch or walked into a bank branch with your physical paycheck and had to fill out a deposit slip. And if you wanted some cash, you had to fill out a withdrawal slip also and wait your turn in line. It was always a line. You get up there and, you know, you had to do both transactions like in person. So, right? It's hard to imagine now. It's like not having a microwave. It was crazy. But that before this act, that's what it was. This act, by the way, also opened the door for online banking, like the ability, by the way, to have your paycheck electronically deposited directly into your bank account. That was huge. I mean, I remember when that first happened, it was like magic. Like, whoa, wait a minute. You mean I get paid and the money just appears in my bank account? Holy cow. So that was this act. All right. So think about what's going on, right? We talked about the evolution of business. In the early, what happened in 2000, a big dot-com bubble burst, right? So there's a lot of economic upheaval going on. And then we also had 9/11, right? So think about what's going on. The economy is taking a huge hit. So in 2002, we passed the Sarbanes-Oxley Act. So that started the process of kind of tightening up the financial markets again a little bit more, right? So one of the things it did is it had provisions to ensure that external auditors were offering fair and unbiased opinions when they examined a company's financial statements. So that was a result of a lot of big financial scandals where people lost a ton of money. There used to be this ginormous company, for example, called WorldCom. They were like, you know, AT&T or Verizon, right? They were huge. Well, unfortunately, they weren't being managed that well, and they were actually losing a lot of money, but their CEO and chief financial officer, and I think a couple of others, they colluded and started cooking the books. Well, at the time, there was already that law that required external auditors to provide an auditing that external auditing report. That's not the name of it. I'm blanking right now on it. That was still the case, but the law was such that it was pretty easy for collusion to take place between the external auditor and the company's hierarchy. And so there used to be a consulting company called Arthur Andersen. They were huge. I mean, they were very famous, right? They were a huge consulting firm. Well, they colluded to cook the books because they were being paid off under the table. The CEO and gang were cooking the books to make it look like the company's stocks, you know, the company was making money hand over fist. So their company's stock price went way up and they got humongous gazillion-dollar bonuses because of it, even though the company was actually doing this. It was losing money hand over fist. They were just trying to make their money on their way out. Screw everybody else. Screw all our employees. Screw all the investors who are investing their life savings in our stock, thinking that it is going to be profitable for them. Of course, it all hit the fan. Arthur Andersen went out of business. WorldCom went out of business, and people lost millions. So that was, you know, stuff like that was happening. So that's why the government stepped in and said, hey, we need to fix this. So that's what Sarbanes-Oxley was supposed to do. 2010. Now this is getting to where maybe some of you remember some of this. The Dodd-Frank Act 2010. That was really controversial. The book makes it sound like all these laws are like everybody loves them and it's all hunky-dory now. This is really controversial. It really expanded the Fed's authority over non-depository institutions. For example, hedge funds and mortgage brokers, their jobs were greatly impacted by this and made harder. It also created now this sounds good. It created the Financial Stability Oversight Council. Make sure that's in your notes. The Federal Stability Oversight Council. Now, it sounds great. So their job was to identify emerging risks in the financial markets and then to take action before something bad happened. So their job was to kind of look into a financial crystal ball and look for indicators in the markets like that there was trouble ahead. And then their job was to advise Congress, hey, we think something bad is going to happen. This is what we think you should do about it. This is what they would tell the Fed, what the Fed should probably do, give them advice, right? The chairman of the Federal Reserve Board is a very powerful person, supposed to be nonpartisan, like non-political. Hopefully it is. And then they would make decisions about growing or shrinking the money supply, for example, to stave off disaster. Now that sounds wonderful, but you know, this is the government. So it's very debatable if this council has ever done anything useful. We may never know, but we get to pay for it with our tax dollars. All right, let's talk about some of the securities, and we'll finish up with, we'll go through as far into this as we can today. Let's talk about the bigs. These are the main types of securities. I'm sure you've probably heard of most of these, right? Stock, you know, there's more than one kind. There's common stock and there's preferred stock. There are bonds, convertibles, which are kind of an amalgamation of preferred stock and common usually, or preferred stock or bonds and common stock. Talk about that in a second. Mutual funds, you've probably heard of that. A lot of our retirements, whether you know it or not, like when you start working somewhere that has a 401k that you can contribute to, which you should do as soon as you get a job that offers it. Talk about that in the next chapter. And ETFs. So these are the bigs. All right, so if you get a test question, by the way, that says what is the most common form of ownership in a corporation, it is not a trick question. Common. It is common stock. That's why they call it that. It is the most basic form of ownership in a corporation, right? All right, so if you buy stock in a company, you have certain rights. For example, you get to vote on major decisions that the company is going to take. Remember when we talked about the different types of stock ownership? On the board, I drew a picture of kind of how the hierarchy works, right? You got the whole organizational chart of the business, all the employees. At the top, you've got the CEO. Well, the CEO can't just do whatever the heck he or she wants, right? They answer to the board of directors. Remember, I drew that above. The board of directors is elected by all of the shareholders, stockholders, like you and me. We own shares of stock in this company, right? We are the owners. So all the shareholders elect a board of directors. So if the CEO and gang decide that they want to take the company in a certain direction, make some big decisions, they ask the board of directors. The board of directors will say, no on that, no on that, but on all these other things, wow, that sounds good to us, but we need to take it to a vote in the annual shareholders meeting. Remember, by the time you go to the annual shareholders meeting, if you actually go, you could. Even if you only own one share, you could go. By then, you will have gotten the annual report by law. Remember, in that annual report includes all the financial statements, notes of the financial statements, the independent auditor's report, all of that stuff, right? So at that meeting, annual meeting, you get one vote for every share of common stock that you own. Okay, so that's a big right. That's a big deal for major players, right? That own a whole bunch of stock in a company. They want the ability to vote, and there's, you know, a lot of wailing, gnashing of teeth at those meetings, right? People have very strong opinions about which strategic direction the business should go. You also have a right to dividends if the company pays, you know, declares dividends and pays them out. Make sure you understand, if you buy shares of stock in a company, the company can choose to declare dividends, as in they can decide to give you a share of the year's profits as a dividend. You know, it's a few dollars, depending on the stock, a year, or maybe every 6 months, whatever the case may be. They may pay you a dividend like, hey, we made a profit, and you as an owner, here is your share of the profits, right? That's a dividend. Well, the company does not have to pay dividends. They can decide to retain earnings. Remember, retain earnings is they keep the profit and they reinvest it into the business to grow it. Well, something I want you to understand about dividends is a lot of times investors are totally okay with the company retaining earnings and not paying it out to dividends because they're thinking, hey, it's nice to have a dividend, but you know what? I know that I'm really going to make the bulk of my investment money by selling this share at a higher price than I paid for it, the capital gain. So, okay, company, you've made a compelling case that you're going to retain earnings and invest it wisely, and you're going to grow the profitability of the business. And when that happens, I know that the share price of the stock that I own is going to go up, and I'm going to make a buttload of money. So go ahead. See, so it sounds kind of counterintuitive, like that an investor would be like, no, don't give me dividends, don't give me extra money. But it could be worth it. So it just kind of depends. Sometimes they pay out dividends, sometimes they don't. But if it does, common stockholders, hey, they have to get paid. All right. Capital gain, I just told you what a capital gain is. When you buy stock at one level and you sell it at a higher level, that's called a capital gain. So most investors, I say most, a lot of investors make all their money that way, right? It's from the capital gain. You buy low, sell high. That's the whole idea. In fact, day traders, they do it on a daily basis. Like they will literally buy a stock when the exchange opens at one price and maybe sell it at lunchtime and just make a profit off of that. They may, they may buy $10,000 of a share at $10 and sell it at $12 at lunchtime, and they just made some money. You can also lose your shirt doing that, by the way. But most investors, just so you know, most advisors advise people to buy and hold over a long period of time. So if you guys start investing in your 401k, for example, right after you graduate, say you're 24 years old, you fully participate in your company's 401k, they're investing that money in the stock market, well, in the financial exchanges. It probably won't be in individual stocks, it'll be in groups of stock, like in mutual funds, different kinds of funds that invest in stocks, common stock, preferred stock, bonds, all that stuff. Okay. All right. You also have a preemptive right to purchase new shares in proportion to your percentage ownership in the company. So, for example, let's say you are a gazillionaire and you own enough shares in a company that represent 5% of the total share ownership in the company, right? Maybe you own 5% of a big corporation. Great. Well, if the corporation decides to issue new shares of stock, you're not going to own 5% anymore, are you? Because there's more, the pie got bigger. And your piece didn't get any bigger, right? So preemptive right means, hey, first of all, if you want to issue new shares of stock, the CEO can't just decide to do it, right? They have to go through the board of directors, and the board of directors have to take it to a vote. All the shareholders have to agree. If they go through that long, arduous, pain in the butt process and decide to issue new shares of stock, they have to offer existing shareholders the ability to purchase enough of these new shares of stock to keep them at the percentage ownership they were before this happened. So that person that owns 5%, the company says, hey, we're going to issue, so many thousand, 500,000 additional shares. Therefore, we're going to give you the ability to buy enough of them to keep you as a 5% owner. And a lot of times they'll offer those shares at a discount. So that's a pretty cool deal. I mean, that's a very important right. And then lastly, residual claim on assets just means if the company goes under, hey, you're a part owner, right? So if they sell off the company, sell off all of the machinery, the plant, the vehicles, computers, they sell everything, they liquidate the company, Well, hey, you are an owner if you own common stock, right? You're an owner in the company. So you get a piece of that. Whatever your percent ownership is in the company, you get that percentage and when they sell off the company, okay? Because you're an owner. All right, there's also a kind of stock called preferred stock. Now, understand that not all companies have preferred stock. But if a company has any stock at all, it's probably common. It's the most common. But they may also have preferred. In other words, usually you're not going to just have preferred stock. It's going to be common, and then maybe additionally preferred stock. Okay, and then you're not going to have as much preferred stock either. But here's kind of how it works. So preferred stock is just a specialized form of ownership in a company. There's some pros and cons. First of all, I need you to understand though that yes, you have a claim on assets. If the company goes under, you get paid first. Selling off the company, you get paid a piece of that, yours first, before common stockholders. They get what's left over. Your dividends work a little bit differently, right? So I told you that if the company pays dividends, keep that in the forefront of your mind, right? So if the company pays dividends, preferred shareholders don't get as much of a dividend usually, but the cool thing is they get a set amount of dividend and they get it at regular intervals. So you might not get as much, but you know what you're going to get, right? The downside is you don't get to vote. You're not going to make you're not going to make as much dividends as the common, and you're also not going to get the capital gain, probably to the level that common stock will when it goes up. It's going to be a slower. If common stock is doing this, right? Preferred stock is doing this. Okay, you see what I mean? So it's a little bit safer. But again, just remember, let me tell you about this other cool thing, actually, that I didn't mention is the cumulative feature, which is a cool feature. Check this out. If the company decides to retain earnings for a year or two, right? To reinvest that money back in the business, to grow it, right? So the stockholders say, yes, that's okay, you can do that. Well, when they start paying dividends again, if your preferred stock had this cumulative feature, the cool thing is before they can start paying dividends to anybody, like the common stockholders, before they can do that, they have to give you back pay for all the dividends that they didn't pay out while they were retaining earnings. So if they retained earnings for 2 years and you had a cumulative feature and they start paying dividends again, you get a check for 2 years worth of the dividends. Pretty cool, all right? But all the negative stuff, all right? Again, look at the bottom of the screen right now. No company is under a legal requirement to pay any dividends. They don't have to, okay? So understand that. All right, bonds are kind of cool. They're more of a long-term investment. They're kind of similar to preferred stock, but it does not give you any ownership in a company. So if a corporation, for example, offers corporate bonds, you're not getting ownership in the company. All you're doing is granting a loan to a business. It's like an IOU for the business. Also, the government issues bonds to pay for stuff, right? Like the federal government has treasury bonds. Well, so do municipalities. Waco, for example, they will issue a municipal bond to pay for things like, like they're developing that area around the river. close to downtown, like at the end of 4th Street, you pass Crickets and the that really awesome Thai restaurant, Bangkok Royale. I think that's not for Franklin and MLK. That whole area is really pretty. The city of Waco sold bonds to pay for all that. So what a bond is a loan. So let me give you an example. If a corporation or a government sells a 10-year, $10,000 bond, let's say, all right? So you are going to give them $10,000, which they will use for whatever they need it for. And then in return, if it's a 10-year bond, let's say it is a 3.3% 10-year bond. All right, so the $10,000 is the face value, or par value, means the same thing. Face value, par value. Why they don't just pick one, I don't know. Maybe it's just to confuse you for fun. That's the par value. If it's a 10-year bond, that means that 10 years from the day you buy it is its maturity date. If you're the first person to buy it, very important, right? So if you're the first person to buy it, the maturity date is 10 years after it's issued. That's a better way to remember it. 10 years after the date it is issued, not after you buy it, unless you're the first person who buys it, because you can sell it before maturity, but hold on to that thought. The coupon rate is the interest rate. Again, why don't they just call it interest rate? But the coupon rate is the interest rate on the bond that is going to pay out. All right, so you pay $10,000 par value, and the corporation or the government uses that money, right? So that's the par value. The interest rate is the coupon rate. So they're going to pay you whatever the coupon rate is. Let's say it's 3.3%. They're going to pay you $330 per year, and they pay it in 6-month intervals usually, by the way. But you're going to get $330 per year for 10 years, and then at the end of the 10 years, you also get your $10,000 back. You get the par value back on the maturity date. That's basically how bonds work. Okay. There are a number of different bonds that people can choose from. Different maturity dates, different par values, different coupon rates, different current yields. You can sell, here's the important thing, and here's where yield comes in. You can actually sell your bonds to other investors before they mature. But the price they get might not correspond to the bond's par value. Because bond prices fluctuate with conditions in the bond market, okay? So when a bond's market price is above its par value, it's selling at a premium. When its price is below par value, it's selling at a discount. So in other words, let's take our $10,000 bond. Let's say you hold on to it for 5 years and you're collecting $330, in our example, you're collecting $330 a year, and you get that for 5 years. But at the end of 5 years, you're like, you know what? I think I can make more money with some other type of financial instrument with this money. So I'm going to sell it. I'm going to sell it to somebody else, another investor. Well, is that investor going to pay the full face value of that bond? No, probably not. Why? Because you've already collected half of the interest payments. So they're not going to pay you the full $10,000 for it. They're going to pay less for it. Okay. So the current yield is essentially, it expresses the bond's interest payment as a percentage of its current market price rather than its par value. I'm going to say that again. Make sure you write this down. The current yield expressed as a bond's interest payment as a percentage of the bond's current market price rather than its par value. Okay, so if the current market price of our bond, let's say that it's $8,640, right? It's not 10,000 because it's already been, you've already gotten the benefit of some of the interest payments. All right, so let's say that the current market price is selling for $8,640. So if you take your $330 of annual interest divided by the current market price, which is $8,640, then the current yield, if you do the math, is going to be 0.038 is what the calculation is going to tell you, which is, if you move the decimal over, 3.8% as a current yield. Okay, make sure you wrote that down because you're going to get some test questions that are exactly like that. Okay, so unlike dividends on common stock though, make sure you understand that a company does have a legal requirement to pay you those interest payments at those regular intervals, whether it's every year or every 6 months, usually every 6 months. They have to pay you those interest payments because it's a loan. You're not an owner. It's a loan, and they have to pay you your interest payments. Okay, so you might ask yourself, why on earth would anybody buy a bond at a discount? Like, why would you pay less than, well, the reason that could happen is because the investor could be thinking, you know what, I think that because of the market volatility right now, this is a safer place to put my money. And so I'm going to do that because it'll keep my money safe and protect it from some of these wild fluctuations that we're seeing in the markets. So some people will actually buy it at a discount. All right, so we covered all that. Okay, read that, think about it for a second. All right. Let's talk about convertibles for a second. Convertibles are pretty cool. We go 5 minutes. Okay. So convertible securities are either bonds or preferred stock that investors can exchange for so many shares of common stock if they want to at some point. So for example, let's say that you are an investor and you buy some sort of preferred stock that has this convertible feature attached to it. And by the way, a company would offer a convertible feature as an enticement to get people to buy it. Okay, it's a form of utility, right? So you buy some preferred stock with this convertible feature, and let's say the company's stock, common stock, starts taking off like a rocket ship. It's like, holy crap, the company just came out with some new product. It's selling like hotcakes. And as a result, the value of common stock shares are going up like this. Well, meanwhile, my preferred stock is just kind of ebbing and flowing along, right? Below that. So the convertible feature would say, hey, you know what? I have the option to trade my shares, each of my preferred shares of stock, for so many shares of common stock. Now, it's not going to be 1 for 1, right? Like you may, for every 5 shares of preferred stock, you might get 1 share of common stock. But you would want to exercise that option if the common stock was taken off and doing really, really well. You'd want to get in on that. And it could be, I don't know what the ratio is. It could be 2 for 1. It could be a percentage, right? But you'd want to do that if the company's doing really well. But by the same token, if the company's shares of common stock were tanking, they go down, but the preferred stock is still ebbing and flowing up here, right? So what would you want to do as an investor? Hold what you got. Just hang on to what you got. Okay, make sure you understand that concept, because that is the test question you're going to get. Okay, that's an easy one. I mean, hopefully. Okay, if you forget, you need me to explain it again, just call me, I'll explain it. All right, finish up with mutual funds. Hopefully. All right, so a mutual fund, think of a mutual fund as an investor. They're an institutional investor. So they pool a bunch of money from a whole bunch of investors, and then they sell shares of that investment bucket. And they have professional fund managers that invest that money for you in a very diversified way. Now, here's the cool thing about mutual funds. A, they're professionally managed by people who hopefully know what they're doing. And they invest the money in a very diversified way. So here's what diversification means. This is a really important business concept. Diversification means that you buy a lot of shares, types of financial instruments in different types and in different industries, so that if you have losses here, hopefully you make up for those losses with gains over here. Now, the thing is, you and me would have a hard time investing in making really diversified investments, because you'd have to buy a whole bunch of different things in a whole bunch of different industries. That would be really expensive. So this is a way that you can just buy a share of a pool that is invested in that really diversified way. See what I mean? It's a very low cost way to get in on a very diversified investment portfolio. Okay, so most of your retirement investments, by the way, are invested in different types of mutual funds. Professionally managed by people who hopefully know what they're doing. It's really easy to get your money out. No sweat, but you're going to pay a penalty if you pull them out too soon. Know that. And they can be opened, open-ended or closed. Okay. So an open-ended mutual fund means it doesn't have a fixed number of shares, nor are its shares traded like stocks. Instead, the mutual fund issues additional shares when demand increases, and it redeems or buys back old shares when investors want to cash in. Okay. So make sure you understand that a closed-end fund issues a fixed number of shares, and invest the monies received from selling these shares in a portfolio of assets, right? So shares of closed-end funds can be traded among investors just like stocks. Make sure you know the difference. All right, we're out of time. Finished up for today. We'll finish mutual funds and move on Thursday. All right, have a great rest of your day. Thank you for being here, and I'll see you next time. All right, take
Bye.
care. Bye.
We were saying bye to.
I see Professor Gray. I'll see you on Thursday.
All right, take care.
All right,
Hey,
you too.
I'm gonna fix your stuff.
Okay, thank you so much. I appreciate it.
All right, take care.
All right, see you Thursday.
All right.